Hi, my name's Carrie Nicholson and I'm with Meritrust Credit Union in our Financial Education Department. Today I'm going to share with you about credit. What is credit and why it matters to you? Okay, so let's talk about what credit is. Credit is the ability of a consumer to borrow money to be paid back at a later date. So there are two components to credit: your credit report and your credit score. Your credit report is just a detailed document that lists your current and past debts, as well as your payment history and length of history on those debts, and any public records or debt inquiries that you may have. So just a long list of your past and current information. You can think of it as a snapshot, just a picture taken in time. Your credit score, on the other hand, is a score based on what is actually on your report. So this score tells lenders about your credit worthiness. It's calculated using the information in your credit report. So the credit score is typically in a range from 350 to about 8 or 850. So you can think of this as even what grade you're receiving in a class. So you know that A is a great grade. You know that F is not so great. Same thing with your credit score. The higher the score, the better your credit is. Next, let's talk about your credit score and what makes up your credit score. There are 5 factors that make up your credit score. The first one is your payment history, and this comprises 35% of your credit score, so it's the biggest factor in your credit score. This means you'll want to make sure that you make your payments on time. Any payment that is made 30 days past due or more will show up as a late payment on your credit report and can have a big impact on whether your credit score goes up or goes down. The second component is debt usage or amounts owed. This is the next biggest factor in your credit score, as it makes up 30% of your credit score. So what this is talking about is how much debt or credit you've used compared to how much has actually been extended to you. So if you have a credit card that you have a limit of $1,000 on, you wouldn't want to use any more than 30% of that credit line. So that would mean you'd want to stay at any given point around $300 or less on that $1,000 credit card. So that's your debt usage. Keep it under about 30% and you'll be good to go. The third component is length of credit history. This makes up 15% of your credit score, and all you need on this one is just time. So having good payment history over a length of time will help boost up your credit score. So the next factor is types of credit. There are 3 different types of credit that can show up on your credit report. The first one is revolving credit. So think of a revolving door where you can continue to go around and around. These are things like credit cards where you can use them, then you pay them off. You can continue using them and paying them off, so they continue to go around like that revolving door. The next type are installment loans. These loans are paid off in equal monthly payments until they're paid off in full over a set period of time. So once that loan gets completely paid off, then that loan or account is now closed. The third type is a mortgage or a home loan, and this is just getting a loan in order to be able to purchase a home. So those are the 3 types of credit, and those make up 10% of your credit score. The last factor in your credit score is new credit, or also called inquiries. This is any time that you apply for credit, such as a credit card, auto loan, home loan, anything like that. This will show up on your credit report as you have applied for credit. You don't want to have too many of these, so we just recommend applying for credit as needed, because if you apply for all types of credit cards and all types of loans in a short period of time, this can have a negative impact on your credit report. So again, just recommend that you apply for credit as needed. So now that you know the 5 factors that make up your credit score, let's talk about what you can actually do to build or improve your credit report and score. The first thing we recommend is, of course, making sure that any payments that you have, making those on time. The next thing we would recommend is to make sure to keep your balances low, under or at that 30% debt usage ratio that we talked about previously. Next, try keeping your accounts open for at least a year. That'll give you a good length of credit history to start getting that length of history built up for you. Another thing you could do is to apply for a couple of different types of credit, to have a different type of credit mix on your credit report. So maybe you get a credit card and a personal loan, so you have 2 different types of credit mixes on your report. Lastly, don't open too many accounts too quickly though. Only apply for credit when needed. So now you know about credit and why it matters. With this information you have, you can now go forth and make informed decisions on helping you establish your own credit.